So we were discussing the different sources of working capital. We have gone through these. Just to summarize what each of these mean, we will look at each of these sources one by one. First of all, cash credit. It's a type of a short-term loan that is taken from banks and other financial institutions. So whenever companies require working capital for a short period of time, they take it in the form of this cash credit. All right, it's like a short-term loan taken maybe for a few days, a few months, or even up to a year, and it has to be repaid to the bank within that time period. So it acts as a source of the short-term or temporary working capital that is required for the business. Next is overdraft. Overdraft, as we know, is a facility that is provided to the business account holders or the current account holders, wherein they get to withdraw more than the amount that they have in their current account. Unlike savings account, wherein let's say if you have 10,000 in savings account, you can withdraw only up to 10,000. You cannot withdraw 10,500. More than the existing amount cannot be withdrawn. But in case of a current account, the facility for overdrawing is available, which means that even if you have lesser amount of funds, you can draw more than the amount of funds that exist in your account. Accordingly, a certain interest rate will be charged depending upon how fast or how soon you repay that amount. You will also have to pay the interest on that overdrawn amount. Okay. Next, we have public deposits. Similar to how banks accept deposits in the form of savings or current or fixed deposit accounts. Similarly, companies or corporates are also allowed to accept deposits from the public. That means they can take certain amount of money in the form of public deposits, issue them certificates for these deposits, and upon the period of maturity, a certain period of time, that amount will be repaid to the public. It is very different from your shares or share capital. That is, in case of share capital, once the amount is taken from the public, it remains with the business for the longest period of time. In fact, in case of equity shares, it remains perpetually. It remains forever with the business till the time of its liquidation. But unlike shares, public deposits are short-term deposits, short-term investment made by the public in a company, and upon maturity that money will be returned to them. Next is the sale of investments. Just like we invest in a property or gold or shares of companies and all other types of investments, similarly companies also invest in all these different avenues. So whenever they are in need of money, in need of working capital, and they don't have other sources of working capital, or they feel other sources are a bit expensive to raise money from, right? Like you have to pay interest on bank loans, you have to pay interest on deposits or overdraft. So in that case, they opt to sell their own investments in order to raise that money. Instead of taking a fresh loan, they rather sell off their investments in all types of assets. It could be gold, property, and so on. And they, whatever proceeds, whatever amount they get from the sale of such investments, that is used in the form of working capital. Next we have fifth one is commercial papers. Again, very similar to public deposits. Commercial papers are also for a very short period of time. They are meant for a few months, 2 or 3 months, or even up to a year. And these commercial papers are what are issued by companies. It's just like you have government issuing treasury bills that are short-term money market instruments. Similarly, you have commercial papers that are small short-term instruments that are issued by companies. A certain rate of interest, a coupon rate, will be paid by them to the investors, to the people who invest in these commercial papers. So again, for a short period of time, these commercial papers or the amount raised from these commercial papers acts as a sort of a source of working capital. Next we have is advances, and by advances I mean advances from customers. So what this means is, whenever a manufacturing company or a trading company sells a product or a service to a customer, more often than not, in some cases, and in case of some sectors or industries, advances are normally taken from customers, especially if the customer books or tries to reserve a particular product for some period of time. So let's say if a customer is booking a car, the automobile dealer is going to take an advance. Or let's say in case of services, if you are reserving, let's say, or making reservations for a hotel, you have to make some booking or pay some advance money to the hotel for the service that they are about to provide you in a few days time. Now this advance which the business gets prior to providing the goods or the services, that advance again acts as working capital. So at least for a good period of time, at least for the next 2-3 months, till the time that service is provided, you have some amount in your hand in order to carry out other working, day-to-day expenses of yours. So that working capital becomes available. Next we have is trade credit. That is, whenever sale takes place between a buyer, a seller, some time may be provided to you in order to make the payment. So for example, if you are the buyer and your suppliers allow you a credit period, or they give you trade credit of 3 months. So in that case, you have 3 months to pay off your suppliers. All right. Now, within that 3 months, you would have certain requirements of working capital. You have to pay salaries, you have to pay your rent and so on. So that, let's say for example, if you're supposed to pay 10,000 to the suppliers, that 10,000 is available to you, correct? You don't have to pay it immediately to your supplier, but he has given you a 3-month period. So you can easily use that 10,000 for the next 3 months, and after 3 months you can arrange for that 10,000 which is to be paid to the suppliers. So in this way, that trade credit period which is allowed, it serves as a source of working capital, because it allows you that money in your hand to be used over a long period of time. Next we have is bills discounted. We've already seen it with the help of an example wherein, when two parties, the seller and the buyer, trade with each other, and the buyer is supposed to pay a certain amount to the seller, sometimes the buyer may draw a bill of exchange, which means it's a promissory note in which the buyer is promising to pay the seller a certain amount on a certain date, right? But the seller, if he is in urgent need of that money and cannot wait for the maturity date of the bill of exchange, what the seller can do is go to the bank and discount that bill of exchange. Discounting basically means the bank will provide you the money by deducting a small amount as a discount or a commission. So the seller gets that amount and it acts as a source of working capital for him, and he does not have to wait till the maturity date of the bill in order to recover that money. So he can get quick working capital through this source by discounting the bills. And finally, we have factoring. Like we said yesterday, in our balance sheet at any point of time, we will have a lot of debtors, people or customers who are yet to pay us, people to whom we have sold a certain number of goods, right? Now, we have given them time, we have given the debtors time, but sometimes those debtors may not meet those deadlines and may not pay you in time, and they remain outstanding over a long period of time. So in that case, a company can approach something called a factor. Okay, a factor is nothing but an agency that works towards the collection of receivables from all these debtors. So all those debtors, whatever the amount of debtors you have in your business, are transferred to this agency called the factor. The factor pays you the amount that the debtors owe you, and then it carries out the collection of those debts from all these different debtors. So collection management, receivables management is handled by your factors. So those were all the sources of working capital, at least the major sources of working capital that we have. Of course, it's not an exhaustive list. There are many more to the list, many other types of sources that different companies rely on.